Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. The federal government has unveiled new measures to help Canadian businesses hit by U.S. tariffs on steel, aluminum, and copper. The $1 billion program will provide financing to affected firms and will also add $500 million to the existing tariff response initiative. The move is in response to U.S. President Trump's recent 25% surcharge on products that contain the metals. Industry Minister Melanie Joly says Canada must defend its workers and support its businesses.
We know that we can't control the White House. We can't control what's going on south of the border, but we can control what we're doing here at home. The steel, aluminum, and copper sectors are key. They're key, obviously, to our economy, key to our manufacturing sector, but also key to our sovereignty. Should Canada be one day in conflict, we need to be having these capabilities, particularly on the steel and aluminum side. And of course, for everything linked to our electric system and AI, and Evan would know about that, copper is extremely important as well.
The U.S. is denying an Iranian media report about Tehran striking an American naval vessel with missiles. It happened hours after U.S. President Donald Trump said the U.S. will help ships stranded in the Persian Gulf transit the Strait of Hormuz, calling it a humanitarian gesture. The plan left ship owners confused, very few details provided. Now, in response, Iran's military said U.S. forces would be attacked if they entered the strait. OPEC Plus nations are going to increase slightly crude production next month as the Iran war continues to impact global oil supply. During a virtual meeting on Sunday, the group decided to raise production by close to 200,000 barrels a day. However, the move is mostly symbolic until the Strait of Hormuz is fully opened. This will be the third consecutive monthly increase by the organization. It comes after the United Arab Emirates' surprise exit from the bloc. And taking a quick look at the markets right now, and the TSX is down. It's been hovering right around flat pretty much, being dragged down by consumer staples, materials, but on the plus side, tech is up and healthcare. They're both up by 1.3, almost 1.4%. South of the border, it is a mixed bag down there as well. S&P 500, pretty much a wash right now. Dow Jones off by 0.4. And going the other way, the NASDAQ is up by 0.25 point. Yeah, North America markets a bit all over the place right now as tensions between the U.S. and Iran escalate, threatening a fragile ceasefire. For more on this, our next guest says he remains focused on choosing high-quality, predictable businesses. While he isn't making any short-term predictions, he cautions there are a lot of lofty expectations built into the market at the moment. Here to tell us more, Jason Del Vicario, portfolio manager at Hillside Wealth Management, IA Private Wealth. Jason, thanks as always for joining us.
Thank you.
All right, so the lofty expectations, how lofty are those expectations to you?
Well, I mean, if you look at the some indicators of valuation that we look at, for example, Warren Buffett's favorite indicator is the sort of aggregate value of the markets divided by GDP. That's at the highest level it's ever been. If we look at the Case-Shiller PE ratio, which is a PE ratio that normalizes earnings, so it looks at the average earnings over the past 10 years, and we divide that by, have the price divided by those earnings, we're at the second highest level it's ever been, only surpassed by the number that was achieved in the year 2000 and other notable periods where the markets were at these levels was in 1929, which of course led to forward rate of returns that were rather anemic. So, if we look at the valuations, certainly south of the border, less so here in Canada, but, we do see elevated valuations.
And is there a concern we could be looking at 1929 or the .com?
I mean, yeah. I mean, obviously, there are similarities in terms of the valuations. What happens going forward, I think, is anybody's guess. Of course, in 2000, we saw the market sell off by 50%. In 1929, by 90%. I think we had a much different central bank and sovereign wealth and debt picture in the 1930s that would probably lead for that type of drop to be, not in the cards in the future. And, in the short term, just because the markets are expensive, that doesn't mean that we're on the precipice of a 2008 or a 2000 type of drop. But what I will say is that if we look forward 5-10 years down the road, these valuation levels, so when the markets start at these valuation levels, we're usually looking at a fairly anemic long-term rate of return. So I would say that in the short term, the market is probably doing a good job at pricing short-term economic realities, but perhaps not longer-term realities, as evidenced by previous scenarios where valuations have been at these levels.
And now let's throw in earnings, what we've seen. How does that mix everything up?
Yeah, I mean, history rhymes, but it never repeats itself. This is a very peculiar market because you have one area of the market, particularly AI. Also, in the short term, we have oil, gold doing very well. So you have pockets of the market that are very frothy, very overheated, I would suggest. And then you have other areas of the market, consumer discretionary, software, where they've almost been, taken out back and shot. So, you really have this bifurcation in market where we do find quite a bit of value, even though, as I've just said, we seem to be in general quite overheated conditions. So, again, when we look at earnings, we see companies like, for example, we own shares in Louis Vuitton, LVMH, Hermes. Luxury is struggling. So the consumer is struggling under the weight of inflation, higher interest rates, and just simply the political backdrop, I think, has people quite nervous. And then on the other hand, you see things like, the chip manufacturers and designers reporting, very, very, very strong earnings here in the short term.
All right, let's get to some stock picks you're liking right now or looking at right now. Kinsale?
Yeah, so Kinsale is a small E&S insurer in the States. They're founder-run, founder-owned. They don't have debt. I think viewers know the types of companies that we look for here at Hillside. And they've sold off recently, coming down to a valuation metric where the forward rate of return is attractive. This is a company we've been following for a number of years. They have the best combined ratio in the industry, and that is a ratio looking at the losses and expenses. So they're a very, very efficiently run company, and they have sustainable edges in terms of their adoption of technology, as well as, of course, running a very lean business. So we've recently added to this position.
Where's the sell-off coming from then for it?
So they have they have large exposure to the construction industry. And so when the profits in one particular sector of the insurance space become attractive, it will inevitably attract competitors. And so Kinsale is a very, very, they're very focused on generating a profit. And so when other people enter the space and maybe they're less profit motivated, they're more interested in terms of gaining market share, that can hurt people that are return focused, such as Kinsale.
Okay.
But we see this as a short-term issue.
All right, let's get the other two in here. I want to say
Sure.
Cop Art because it's fun to say, but it's Copart, I'm guessing, but it's way more fun to say Cop Art.
Right. I've actually never heard it pronounced like that, but let's go with Copart. So Copart is a company that we followed for about 8 years. We've initiated a position in the low 30s. This is a business that was started 40 years ago by a Vietnam War vet. It is in the very, very sexy business of auto salvage, basically junkyards. And they compete head to head. There's really only two companies that have 80% of the market, with a company that is owned by RB Global, IAA. And the two of them, as I said, control 80% of the market. The advantage that Copart
stop it. I'm going to get you saying it now.
That's right. Over IAA is that they own their junkyards. So whereas IAA leases them, Copart owns them. And that's important because, of course, there aren't a lot of municipalities or jurisdictions out there that are looking to give out permits for junkyards. So that install base of the owned real estate they have, we see as a long-term sustainable advantage for them. And they're available at a favorable price right now.
All right. And I love junkyards. I drive a 93. 30 seconds, Constellation Software.
Constellation Softwares are, one of our largest positions. We've owned it for 12 years. It is finally at a valuation level where we think the forward rate of return is attractive. I've spoken at length about this company in the past, and we think for those who don't own it, this is a good time to initiate a position.
Perfect. We'll wrap it up there, Jason. Thanks as always for joining us.
Thanks, Roger.
Jason Del Vicario is portfolio manager at Hillside Wealth Management, IA Private Wealth. When we come back, how OPEC is managing strained oil supplies after losing one of its key members. That's next. With trade negotiations looming, Prime Minister Mark Carney is pushing back on the idea of using energy and critical minerals as leverage, a stance now drawing sharp criticism from the Conservatives. CTV's Jeremy Sherrill has more.
With a mid-summer deadline fast approaching to review Canada's free trade agreement with the U.S. and Mexico, Conservative leader Pierre Poilievre had this question today.
So if energy and minerals are not going to be leverage for Canada in these negotiations, what leverage does Mr. Carney claim to have?
That's after the Prime Minister told the Canadian press this week Canada won't leverage our energy resources or critical minerals in trade talks.
Let's be clear, we're never going to cut our American allies off of our energy or selling our resources, but we can offer in the negotiations to build up our resources in a way that helps our continental security, that keeps both of us safe, strong, and rich.
The Prime Minister has so far signaled he's in no rush to negotiate a new deal ahead of the July 1st review deadline.
You're best to wait for the right agreement as opposed to rushing into something because of the potential permanence of that.
This former special advisor to Prime Minister Justin Trudeau on Canada-U.S. relations believes time is in Carney's favor.
We have no idea what the conditions of the coming months are going to look like, what domestic American pressures are going to be felt by the president and his team, what geopolitical priorities are going to take precedence over that of a conversation with Canada.
With U.S. midterm elections around the corner, Trump's Republicans could lose control of Congress in November, leading to speculation the Prime Minister could be waiting to see if that happens.
There's a lot of speculation here that Canada may be waiting it out.
But in an interview with CTV's Question Period, Colorado's governor says that's unlikely to make a difference.
Sadly, having served in Congress 10 years, I have to tell you that's not really the way our system works. We give tremendous authority to the executive in negotiating these kinds of agreements. Pressure, yes, but I don't think this president gives into that pressure.
Now, that July 1st deadline is not to get a new deal done, rather just to decide whether to review the current one. And right now, neither side appear to be in a rush.
And that's CTV's Jeremy Sherrill. OPEC Plus nations are set to slightly increase crude production next month to about 200,000 barrels a day following its first meeting without the United Arab Emirates, which officially left the group on May 1st. To break down what's next for OPEC and the oil market, Jeremy Irwin, global crude lead at Energy Aspects. Jeremy, thanks very much for joining us.
Yeah, thanks for having me.
So was it a normal meeting yesterday? Could we call it that?
Yeah, we would characterize it as pretty status quo. They continued on the path of unwinding those voluntary production quotas as expected. Now, this won't really translate to higher crude exports given the ongoing disruptions in the Strait of Hormuz. But yeah, status quo.
Any conversations about the UAE added, or were those being held in back rooms?
I think the situation with the UAE had been building for some time now. The timing of this announcement is very much taking advantage of the current situation where there was some concern within the group that their departure would lead to a sell-off in pricing. And now, given the magnitude of disruptions we're seeing currently, obviously that overshadows their departure, and you didn't really see that downward pricing pressure on crude prices. So I would say that sort of explains the timing from our view.
And so was that the UAE playing nice with OPEC, or?
I think the UAE has had more ambitious growth plans than the group had, allowed them to do so within their framework of managing the market. So I would say, yes, they're taking advantage of the timing of the situation, and I'd say it's a bit of a peace offering in the fact that they are leaving the group. So that's how I would characterize it.
Now, and how much of an impact will it have on OPEC if the UAE, assuming everything is resolved, bumps up their production? I think they want to go from about 4.5 to 5.5 million barrels. What kind of an impact will that have?
Yeah, we would still think OPEC is going to be effective in managing the market. Still, Saudi Arabia has a pretty big bat to swing there, and some of the spare capacity they withhold. So we still think the group will be effective in managing the market. Now, the UAE probably grows a little bit quicker. And, could this have more supply risks down the road? Potentially, but I think that's to be seen. We have to see how Middle East production comes back after all these shut-ins. So there's a lot of unknowns. So I'd say it's a little speculative to assume that it could pressure pricing way in the future.
Now, obviously, more production, more money for the UAE. What are the other benefits, and what might be the shortcomings of them leaving?
Yeah, I think the benefits are exactly what you say. They can grow production without any type of restrictions, and they can sort of maximize those revenues for the country. Now, the shortcomings are probably more contention amongst their membering states and borders. Within the group, I don't think you're going to see any outright conflict there, but maybe some other economic risks to, say, trade agreements or regional trade flows outside of energy.
Because all of their neighbors, I think, are members of OPEC, are they not?
Yeah, essentially.
So what could we possibly see? Trade agreements being torn up, or what else?
I think just more of a hostile negotiation or negotiating type of scenario when you're looking to sign trade agreements outside of oil. So there might be some bad blood and a little bit of contention within the group from disrupting the unity in a time where, a lot of member countries would have emphasized the need for unity in managing the market. So I can't point to anything specific in terms of a specific trade deal that's at risk, but that's sort of how we would frame it.
And from the OPEC side, are there benefits to the UAE leaving, or is it mostly a negative to them?
Yeah, I would say the more market share you control, the larger your ability is going to be to manage that market. So I would characterize it as mostly negatives to be losing some market share, but still they withhold a sizable enough position in global oil markets to be effective.
And the Saudi Arabia and the UAE, they've been kind of jabbing at each other for a while now. Will that continue, or will it heat up, or could it actually cool down?
I think it would probably continue if I had to make an assumption right now. I don't expect it to heat up, but we think it probably continues. And this could be something the Saudis bring up in the future when they're discussing other trade negotiations like we kind of discussed.
And then bigger picture with all this unfolding, with the backdrop of Iran, if and when the strait is reopened, how quickly, because UAE is not involved now with OPEC, how quickly will things get back to normal there?
Yeah, so our basically latest base case is that flows are going to be disrupted through the month of May. And that's largely because oil inventories in Iran and what the U.S. is trying to do by blockading the trade flows to withhold oil revenue to Tehran is going to take about 4 weeks until you see tankage in Karg Island and Iran reach tank tops, which then shuts in their crude production, which then impacts their future oil revenue. So in our view, you're not getting back to pre-conflict levels probably ever. And our current base case would be 50% of pre-conflict transit by end of June. So another month of pretty magnitude and sizable supply losses.
And with Iran, I heard someone say at one point that they're even considering essentially digging ditches and leaving the oils out in the open stored. Is that feasible? Is that doable? Or would it make a difference?
Yeah, I mean, there could be small little workarounds like that, but in the big scheme of things, it's not feasible at the scale they would need it. I mean, they produce over 3 million a day, export as much as 2 million in a good day. So, I mean, it's just not feasible to really create an ad hoc short-term fix for that type of size.
All right, we have to wrap it up there, Jeremy, but thanks very much for joining us.
Thank you. Jeremy
Irwin is Global Crude Lead at Energy Aspects. Coming up, we'll see what's weighing on transportation stocks today with Bloomberg's Avalon Purnell. Time now to take a look at today's market movers, and for that we're joined by Bloomberg equities reporter Avalon Purnell. Avalon, thanks very much for joining us.
Thanks for having me.
Okay, FedEx, UPS, and Amazon, I guess it all kind of ties in really, doesn't it, what's going on today?
Yeah, FedEx and UPS shares are both tumbling more than 9% today after Amazon's decision to expand its logistics offerings. Part of that's called Amazon Supply Chain Services, will offer businesses access to Amazon's expansive transportation and logistics network, which spans ocean, air, ground, rail, and freight. And it's already said that firms like Procter & Gamble, 3M, and American Eagle have already signed up. So that's very much of a point that it's worth to note that this could take a pretty big bite out of FedEx and UPS's businesses.
And so Amazon already has some logistics going on. How long have they been doing it for?
Yeah, I mean, in order to get those deliveries, especially for one-day shipping, they have various things across the country and also the world just to fulfill those orders. And now for those existing spaces, if they have excess capacity, they're now offering it to companies that aren't necessarily delivering through Amazon, but you're now able to get an order from, say, American Eagle directly fulfilled by Amazon, even though you're not buying the order on Amazon.com.
Yeah, but it'll still be processed and delivered by Amazon. And how big is it relative to FedEx and UPS for deliveries? How do they compare?
Well, it's still early stakes yet. This was announced today. We're going to still keep an eye out for what exactly the numbers are going to look like. That hasn't been released, but we will keep an eye out.
Okay, so it's just the start, but boy, oh boy, the markets are reacting to it, aren't they?
Yeah, and I think it's also kind of important to note that Morgan Stanley is writing that this could be a watershed moment for North American freight transportation companies. They're predicting that air freight companies and parcel carriers like a FedEx and UPS could be hit hardest. However, truckers, railroads, ocean shippers, and warehouse operators could also be at risk.
Okay, let's move on. Speaking of ocean, cruises and what's going on there.
Yeah, Norwegian Cruise Line reported earnings today, and to say the least, it wasn't that great. Norwegian is one of the biggest losers on the S&P 500 today after slashing its full-year guidance and also giving a downbeat projection for the second quarter. Important to note that the conflict in the Middle East is partially to blame. Norwegian management said that soaring fuel costs, as you can imagine, for those cruise ships are definitely part of the reason for those guidance cuts. Norwegian is forecasting its first annual decline since 2020, and this also represents the sharpest decline in expectations among its rivals. So Carnival and Royal Caribbean have slightly better guidance, but Barclays is writing that those guidance cuts were very much worse than expected, and the expectations were very low going into the print.
All right, we'll wrap it up there, Avalon. Thank you very much for joining us. Bloomberg's Avalon Purnell. When we come back, are Canada's copyright laws entrenching big tech? We'll speak with a digital rights advocate on the push to legalize jailbreaking. That's just ahead. The Financial Times is reporting U.S. private equity group Francisco Partners is in talks to buy Moneris. The Canadian payment processor is a joint venture between Royal Bank of Canada and Bank of Montreal. According to the report, the deal could value Moneris at as much as $2 billion U.S. and may come together by the summer. The Canadian banks put the financial technology venture up for sale last year. We are tracking shares of eBay and GameStop in today's trading session. GameStop is proposing to buy the e-commerce website for $56 billion US. The cash and stock offer from the gaming retail chain comes with a 20% premium. GameStop says it has secured a letter from TD Bank to provide about $20 billion US in debt financing and is pledging to find about $2 billion in annual savings within a year of closing the deal. Shares of Tyson Foods are getting a lift. The company beat estimates for profit and revenue in its latest quarter, driven by sales in its chicken and pork segments. On the downside, Tyson cut its full-year net expenses forecast and saw sales in its beef unit drop 13% year over year. The company has been dealing with soaring beef prices, which has impacted demand. Well, Canadian copyright law treats jailbreaking tech as illegal, even when it's done to repair or modify your own device. Critics say those rules entrench big tech power and stifle competition at a time when other countries are moving to loosen restrictions. Joining us now to explain why Canada should rethink its approach is Cory Doctorow, Special Advisor, Electronic Frontier Foundation. Cory, thanks very much for joining us.
Oh, it's my pleasure. Thank you for having me on.
Okay, let's get the big words out of the way. Anti-circumvention. What exactly does that mean, and what kind of an impact does it have?
Yeah, it's kind of confusing because these are very long technical words, but anti-circumvention just means that if a product is designed to stop you from changing how it works, then we've made it illegal to change it, even if it would otherwise be legal. So in other words, if you have a printer and it's designed to stop you from putting third-party ink in it, generic ink in it, and you change the printer so you can just use your own ink, that becomes a crime in Canada. And it's not like Parliament ever passed the, you have to pay $10,000 a gallon for your colored water Act of, 2011. We just made it illegal to modify printers. And then HP made the printer that only took its ink. And then they raised the price to $10,000 a gallon, making it the most expensive fluid that you can buy as a civilian without getting a government permit. It's pretty weird because, it's yours. You should be able to use it in legal ways.
Are there any other situations like that? I mean, one of the things that might come to mind, auto industry, I mean, people modified cars forever, but now even I think it feels like the auto industry is kind of pushing people towards having to end up at their dealerships to do anything.
Oh, yeah. You hear auto modifying and you think of something like, hot rodding or, tuning the motor or something. No. Like if you want to modify your car so that an independent mechanic can turn your check engine light into a diagnosis, something that if you want to do it through the manufacturer's tools, costs you $10,000 per manufacturer per year. If you want to modify your car so your own mechanic can fix it, that's illegal. If you want to modify your tractor so that you can fix it instead of having to pay a John Deere technician to come out and type an unlock code after you've done the repair yourself, that's illegal. If you're a hospital and you want to modify your ventilator from Medtronic, the largest ventilator company in the world. They pretend they're Irish so they don't have to pay taxes, but they're an American company. If you want to modify it so that when you take a screen out of a dead ventilator and put it in a working ventilator with a dead screen, without waiting for a Medtronic technician to come to your hospital and, again, type an unlock code, that's illegal. If you want to modify your phone so that you can choose which apps go on it, that's illegal.
All right, so are there any other countries that do what we do, or are they more liberal?
Well, so here's the thing. The U.S. passed a law, the first of these laws in 1998, the Digital Millennium Copyright Act. Section 1201 is the thing that makes this a crime. And you can see why they might do that, right? Because American tech companies make a lot of money ripping off Americans by locking them into these technologies. But of course, if we could export the tools to unrig your printer, unrig your tractor, unrig your phone, well, then we could turn their trillions into our billions. So the U.S. Trade Representative went to every single trading partner of America and said, if you don't pass a law just like ours, we're going to hit you with tariffs. So, happy Liberation Day, right? If someone threatens to burn your house down unless you do exactly as you're told and you do it and they burn your house down anyway, you're kind of a sucker if you keep doing it. So now it's kind of a race to see which country will get rid of these laws first and become the country that exports the tools to everyone else, that lets them get more out of their own property, and that takes some of those gigantic margins American companies are earning and puts it in a domestic firm's pocket. Jeff Bezos has always told his suppliers, your margin is my opportunity. Well, when he does it to other companies, that's not piracy. If we do it to him, it is progress.
So is there a country that's maybe close to doing or leading the way and already in the process of?
Well, Malaysia just tore up all their trade agreements with the United States, and they know a thing or two about making electronics and high-tech products. But as far as I know, it's still a race to be seen who gets there first. There's the European Union is building this thing called the Eurostack, which are like equivalents to all the U.S. tech exports that run on European data centers in the European Union. The problem they're going to run into is that like getting the data off of those American platforms and into a European platform is going to require circumvention. They're going to have to jailbreak these things so they can get the data out. And right now, it's kind of like they're building really nice public housing for people in East Berlin, but they're building it in West Berlin. And eventually, they're going to have to tear the wall down because no one's going to risk getting shot in the back to move into even a very nice apartment.
Now, it wasn't part of the reason these were brought in was to keep for security and cybersecurity by protecting software and codes and things like that? Is there not a danger now you become more vulnerable if we open it up?
Well, no, it's the opposite, right? Because right now, if a company decides that something that's wrong with its product is something they don't want to fix, if there's a vulnerability they don't want to patch, or if they deliberately introduce defects, so you think about these American products that steal our data, right? That's obviously a defect in the product if that's how it works. Unless the company decides to fix it, you're out of luck. And what's more, when security researchers discover defects in products, revealing the defect to you and saying, hey, that pacemaker that you trust, that automotive informatics system that you trust, it's actually really dangerous. And a third party could break into it and ruin your life or steal your data. It's illegal to go public with that information because you might help someone jailbreak the product. And so you have this kind of fool's paradise where the bad guys can figure out what's wrong with your products and the manufacturer knows what's wrong with your products, but you and you alone, the person who relies on those products, you're never allowed to find out about it until, your life has been destroyed.
All right, we got to wrap it up there, Corey, but thank you very much for joining us.
Oh, well, thank you very much. It was nice talking to you.
Cheers. Corey Doctorow is a special advisor for the Electronic Frontier Foundation. Up next, Canada has its first CAD, Canadian-backed stablecoin issued by a financial institution. We discuss more about digital assets right after the break. In a national first, we now have a payment stablecoin backed by Canadian dollars, which received regulatory approval from a financial institution. Let's bring in Didier Lavallée, founder and CEO of Tetra, the company which received the regulatory approval for the stablecoin. Didier. Thank you very much for joining us today. First of its kind, what do you hope to do with this? Why should someone get involved with this? Why would they get these coins?
Yeah, good morning, and thank you so much for having me. Really, stablecoin growth has been phenomenal across the world, mostly denominated by U.S. coins, at least for the beginning of this new trend. And what we were looking to do with this token is bring a competitive Canadian offering to market. We know and obviously can observe that the Canadian dollar is widely used for global commerce. And as more and more of that activity is moving into the digital sphere, we need a competitive offering as Canadian, and this coin will allow you to essentially do that.
Why jump? Why, if someone's using American now, why would they want to jump to Canadian? What are the benefits for them?
Yeah, a lot of businesses we see today that are using American tokens are essentially bearing FX risks by doing so, and they've been asking us, as we have announced our project in September, when are you going to be live? When can we utilize a Canadian-denominated coin? Because we do see operational expenses in terms of using US dollars. So one is essentially better alignment with their business. As they do commerce or cross-border activity, they want to use their native currency or the currency their activity is denominated in, as opposed to having to go to US dollars just for the sake of using stablecoin rails.
Okay, now, so just to clarify, you got approval from the Alberta Treasury Board and Finance. How does that play out across the country and federally?
Yeah, so great question. So today there's no federal framework for stable coins. As we know, the federal government has announced 315, the implementation of the Stablecoin Act, which is currently going into drafting, and we expect will be launched, within 18 to 24 months. In the meantime, there's no real regulatory clarity around stablecoins outside of prospectus-led stablecoins, but unfortunately it means that those are securities and are very difficult to use. And under this prudential framework in Alberta, we believe we have the right to distribute broadly at the federal level until such a time where there will be federal clarity under the Stablecoin Act.
And when you get that federal clarity, are you feeling what you're doing now will kind of flow within it as well?
Actually, absolutely. We actually believe this is the best alignment that Canadians can get today. This is under a prudential framework by a regulated financial institution that's been operating for 5+ years in the Canadian market. There's a strong reputation behind the brand at Tetra, and we've been properly governed and regulated for quite a few years. But the intent is very much to go under a prudential framework and to utilize stablecoins as payments instruments as opposed to securities.
All right, and you've got National Bank, ATB Financial, Wealthsimple, and Shopify as your partners. What kind of role are they going to be playing with this?
Yeah, our partners have been incredible, and I should also mention all the good work that the folks at Urbana have done over the years in supporting the scale of our company. But really, the stablecoin partners that we announced are all companies that are seeing pain points today with traditional stablecoin rails, meaning U.S. denominated ones, or are seeing the capacity for their businesses to evolve through the implementation of stablecoins. Some of them are very public about their usage of stablecoins. For example, Shopify and Wealthsimple talk about usage quite heavily, and are also always using U.S. denominated stablecoins. So there's a lot of excitement with this token being live and coming to market because it's a simple switch between a U.S. denominated token and our token, and they already have the infrastructure to get going.
Okay, and you're with Base, Ethereum, and Tempo. Do you plan to expand, and how much movement do you expect to see?
We will certainly expand, and the market dynamics always dictate adoption when it comes to the blockchain rails on which you deploy. We chose Base just because there's a lot of volume currently happening on that chain, and they've done a fantastic job as a team scaling their product. Ethereum is the book of record, at the institutional level, so that was an obvious choice. And then we're very excited by what the team at Tempo has been doing. I mean, their progress is exceptional. I think one of the missing ones we talked about in our press release is Solana. I mean, that's a natural extension for us. And then market dynamic will dictate what we launch next. And we're always open to have those dialogue with our customers.
And it's 1-to-1 Canadian. Where are they being held? How will it be audited, verified, things like that?
Yeah. So all of our reserves are with Canadian financial institutions, including Tier 1 banks. We have hired essentially an external auditor, a financial auditor that's going to be doing monthly audits, which will be published in terms of attestations on our website. There's also going to be random checks that are going to happen, which will be publicized as well. And, the entire institution or vehicle is governed and controlled by a financial regulator as well. Just a keynote there is this is activity, when I mean audits, that Tetra's been doing for over 5 years. So we have a very long track record of doing so, and the controls will be the same. They'll be fully transparent. And of course, being blockchain, individuals can go audit themselves via blockchain tools.
All right, Didier, thank you very much for joining us today.
Thank you so much.
Didier Lavallee is a founder and CEO of Tetra Digital Group. Well, if you've been feeling like Canada's condo market needs to go through some change, my next guest has some ideas. We'll find out more after the break. Canada's real estate market has been seeing some consistent declines. My next guest believes the traditional condominium market is no longer viable and needs a revamp. Let's bring in Pooyan Safapur, president of Devron Developments, to discuss this more. And Puyan, thank you very much for coming in and joining us. We appreciate it.
Thanks for having me.
What are your concerns about the condo market? What do you feel is broken about it?
To frame, actually, first, I guess, the extent of what we're dealing with, looking at across the major markets, whether GTA, Vancouver, Calgary, et cetera, they're all in variations of numbers between 80%, 90% down from historical norms. So that's, first of all, what we're dealing with. Mm-hmm. And what the challenge is, isn't really, unfortunately, isn't an easy thing to just point a finger at. And I think that's been a little bit the tendencies to say whether there's an issue with government taxes, whether it's issues with developers, investors, et cetera. But the issue actually is fundamentally how the condo industry is structured in Canada, which is unique and different to everywhere else in the world for the most part. There are very few markets that are structured the way ours are, which is to say that a project needs to be predominantly sold prior to starting construction. And it seems like
80%, isn't it normally when they go?
It's approximately in the ballpark of 70%. It results in that number approximately. And the challenge that it causes, it seems like maybe a small detail, but it fundamentally rewrites how condos are, how they're designed, how they're sold, who they're sold to, and it sends us down this path that we've been on for the past 20 years, particularly where between population, immigration, and home building, we've been on a run. The issue is that when banks require projects to sell prior to starting construction, if you're buying a home, if you're buying at any kind of stage in your life, it makes it challenging for you to buy something, given that you have to anticipate what you want, where you want to be 3-4 years from now. Mm-hmm. And so it creates this gap that we don't have in any kind of other product, whether we buy much less consequential products like cars. We don't go and buy a car that we anticipate we might need in 4 years from now.
So is it developers they build small because they sell quick?
Exactly. So what happens is that with this requirement, then the system sort of almost necessitates a middle person buyer, often an investor buyer. And in markets like in GTA, numbers kind of quote anywhere between 80 to 90% of suites often would have been sold to investors, so not the actual end user, which is a quaint term we have in the condo industry, which I think is a big red flag that we shouldn't have. We don't have end user buyers for shoes and then investor buyers.
So what countries do it differently, and is it working?
Pretty much every other market in the world builds a product, and again, whether it's housing or otherwise, builds a product, and based on the quality of that product, based on how it looks and feels, people ascribe a value and they buy it. So it's built first, then it's sold. What that does is that closes the loop between, let's say, us as builders and the end user who's actually purchasing that. It then basically it creates an incentive for us to create high quality product, larger suites, things that people really actually kind of need, rather than catering to buyers who are investors who may not necessarily, even if they're trying, they may not necessarily anticipate the same kinds of value that an actual user of that product does.
But would that then drive the price up for the buyer, though?
No,
you're talking about the higher end materials, things like that, larger units.
So the incremental cost of higher quality buildings is completely dwarfed by the extreme cost increase that we've experienced due to this structure. This setup and structure is the reasons why, for example, development charges in the city in Toronto have gone up about 1,000% over the last 10 years, because we were building so much fueled on speculation by investors, and from building kind of a product that didn't maybe necessarily always match the end user's desires. And we were building faster than our trade community actually had capacity for. Supply demand increases costs. So construction costs, the city development carts, the broker fees that are associated with investor sales are, instead of a 2.5% usually having a low-rise home, 6%, 8%. There's numbers up to 10%. So there's so much cost that goes into projects because of the system that would be much, much better to put into either quality or bringing affordability down.
So who would have to? Would that be the federal government would have to change that, the provincial, the city, and would developers be okay?
It's a great question, and it's when you have a systemic issue like this, there's two things. We can focus on either trying to change the system or waiting for the system to change. And the other option you have is to try and build what you think is right in that market. And that's what we've tried to do. So focusing on projects like One Marlborough that we're working with our partners at Dorsey. In this market that's compressed, we're actually bringing this, it's a new project we're bringing to market, or a project like 101 Spadina, building, not the typical glass condo. Yeah. So stone masonry buildings, nicer architecture, larger suites, and it's appealing to end users in this market. So that's, I think, the most important thing that actively I think the market and market players can do is realize that segment has changed, and we really need to focus on doubling down on end user and building high quality buildings despite the system.
I got to wrap it. I apologize. Got to wrap it up. We're almost at the end of the show, but Pouyan, thank you very much for joining us today. We appreciate it. And that was Pouyan Safapur, president of Devron Developments. Let's take a quick look at the markets on Bay Street and Wall Street to see how they are doing before we go. The big note on the TSX right now, take a look at Xanadu. Let's bring that up. It's down as much as 60% after the firm filed a prospectus for the sale of nearly 294 million subordinate shares. And you can see that big drop off there. And Market Call is coming up next. And today on the show, we have Bryden Teich. He is Chief Investment Officer of Avenue Investment Management, and we'll be taking your questions on North American equities. And that is it for Morning Markets. I'm Roger Peterson. Thank you very much for joining us. We'll see you back here tomorrow.